think we were right to wait and see how tariffs and inflation and the labor market evolved. There wasn't widespread support at all for a 50 basis point cut today. I think you could think of this in a way as a risk management cut.
Risk management. U.S. equity futures gain after the Fed cut rates for the first time this year, with the chair Jerome Powell keeping policymakers largely united despite President Trump's pressure for a bigger cut. Bargaining chip. China bans its tech companies from using the AI chip Nvidia made just for them. The U.S. describing the move as counterproductive. And our big take today: in a broken Palestine, increased Israeli activity undermines the viability of a Palestinian statehood. We're live from the West Bank. It's just gone 8 a.m. across the Emirates. I'm Jumana Bersachi in Dubai. Well, the fireworks certainly came out of the Fed yesterday. Multiple interpretations as to exactly what messaging we got. Initially, the reaction was that it was quite dovish. They went for a 25 basis point rate cut. Median dot moved to another 2 rate cuts for this year. But then next year, only forecasting a further 1 incremental rate cut, 2027, another one as well. So mixed interpretations as to whether this was actually dovish. The Fed Chair Jerome Powell spoke about some of the downside risks to the labor market, but at the same time framed it as risk management. So what we got by the end of the day was a small pullback for the S&P and NASDAQ. And I will just tell you, for NASDAQ specifically, one stock was in focus. That was Nvidia. The stock ended almost down 3% in trading yesterday on this news story. We're going to talk about that in a moment, that Nvidia's chips have been banned for use within China. So we had also a tech story at play yesterday. This morning, things have flipped. S&P is trading in positive territory once again. We have NASDAQ leaning towards the green too, so sort of brushing off some of the price action that we had yesterday after the event. 10-year yields also whipsaw action. Initially, we rallied through 4%. We got to around 397, I believe, at one point. By the end of the day, though, we ended up 4 basis points higher as the market sort of repriced the further rate cutting cycle from 26, 27 onwards. So we had a bit of a case of buy the rumor, sell the fact in yields. And then the USD also, this one is interesting because remember, into the event, we've been talking about weakness after weakness after weakness for the greenback. Another situation of the Fed delivering on rate cuts, indicating that they're going to do 2 more this year. And yet the dollar rallied. So that's your price action today. So somewhat interesting. Flipping over, also, let's just take a look at how, for example, some of the EM currencies reacted in response to the Fed decision yesterday. And you can see that little blip at the end. In the run-up, we had seen a very strong performance out of this EM currency basket. This is MSCI EM currency basket. Yesterday, we came off a little bit, and perhaps EM currencies wanted to see more explicit dovishness out of the Fed, something that we can discuss with our FX guest later on this morning. Okay, let's also move on and check in on how markets in Asia are faring. Annabelle Jewelers is in our Hong Kong studio. What has been the price action from Asia today, Annabelle?
Yeah, well, it's actually been kind of interesting. I mean, yeah, there's 2 different stories. Firstly, you've got the reaction to the Fed, and then secondly, it's very much still the focus on what's happening, rather, in China's tech space. But I'll kick off what you were saying there about that dollar strength that we're seeing. Certainly, you can see here playing out in Asia here. Most currencies are weaker against the greenback today, particularly watching the Kiwi dollar, actually, because they had GDP figures that came out really undershooting economist estimates, and so telling us that maybe the RBNZ is going to need to act with further easing to come. Otherwise, across the board here, I mean, you can kind of see some expected moves. For instance, you're seeing commodities pulling back a little bit, concerns, as you said, around the health of the labour market and maybe some of those more recessionary clouds, perhaps, building on the horizon, even though they did, I guess, upgrade their growth forecast somewhat. But equities-wise, there's a very clear theme here today. Yes, you've kind of got muted moves, except for the tech-heavy indexes. That's Japan, Korea and Taiwan. And that is actually a really interesting dynamic. If you take a look at some of the movers in China in particular, what's happening is that we're seeing continuing reappreciation of China's semiconductor abilities. And a lot of those companies, Global Wafers, for instance, over in Taiwan, still has supply chains back into China, customers in the China market as well. So that strength we see there is actually benefiting some of the bourses here in Asia. But Huawei, one of the names that's standing out because they just had an upgrade from Goldman Sachs. But generally, there's a lot of positivity here. And more headlines dropping as well, not just restrictions on Nvidia products, and we'll get to more details on that in a few minutes, but also we're hearing things like Huawei, for instance, introducing new chip computing clusters that can give more power and more capabilities around AI as well.
Yeah, that Huawei news also very relevant in light of the price action that we had at the beginning of this year when DeepSeek was unveiled. Annabelle Jewelers in Hong Kong, thank you so much. Let's go back to the Fed now. The Fed Chair Jerome Powell pointed to growing signs of weakness in the labor market to explain why officials decided it was time to cut rates.
I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market.
Joining us is Frédérique Carrier, investment strategy head for the UK and Asia at RBC Wealth Management. At the top of the show, I was going through the market interpretation at various moments of the evening yesterday. Initially, it was perceived to be quite dovish, and then later on, as the press conference was underway, I think the market price action suggested that what the Fed actually delivered yesterday was a hawkish cut. Where do you stand on that debate?
There's a little bit for everyone in this meeting, isn't there? So lowering interest rates twice this year, people are looking at the dot plot. But as you mentioned, 2026, 2027, fewer cuts, and market expectation of the terminal rate has increased just very slightly. I think it's fair to say that it's difficult to see monetary policy as being very restrictive at the moment. It has to be taken into the context of a federal deficit, which is equivalent to between 3 and 5 cuts already. And there's very little evidence in the borrowing market that monetary policy is restrictive. It seems there's a lot of evidence that borrowers have market power. So I think people, probably investors, still scratching their head with this message and are aware that while the unemployment picture is not great, it's really monetary policy is a blunt instrument to deal with it. We think there's more of a mismatch in terms of what corporations need compared to what the skills which are available.
Let me pick you up on what you just said there, that the fiscal deficit is equivalent to, I think you just said 4 or 5 rate cuts, i.e. there is a sufficient amount of fiscal loosening in the economy. Is that enough to keep the Fed from engaging in an aggressive rate cutting cycle? Is that what you're trying to say? So,
yes, we think between 3 and 5 rate cuts is the equivalent of this loose fiscal policy at the moment with the tax cuts and other fiscal plan. And so monetary policy has to remain relatively contained at the moment. We don't think it is restrictive, however.
Yeah. Let's talk about the 2026 thoughts. I mean, there was some attention paid to the fact that Stephen Myron voted for 50 basis points yesterday, but then others, Waller, Bowman, actually went with the majority and voted for 25 basis points. So perhaps you could say there was somewhat of a hawkish surprise there. But how much weight should we really put on what happens in 2026, given we know that the Fed Chair Jerome Powell's term ends in May, and the composition of the Fed and who's voting on the Fed is likely to change? The expectation is that President Trump will be appointing members to the Fed who are likely to be more dovish. Therefore, should we not read in too much about these 2026 dots and forecasts?
So it's probably the reason why the terminal rate has been moved only slightly. There is this expectation that we will end up next year, particularly if Governor Cook is replaced with a much more dovish Fed board. Whilst for this particular meeting, the unanimity of the Fed board members surprised, it's very likely that we will have next year a Fed board which will be accused of political interference a lot more than it has in the past.
In terms of market price action, really interesting that the dollar got a bid after this meeting. Do you think that that's going to hold?
So it's a very small rally in the dollar. And that, given that the recent weakness, it could be sustained, but we think it would be just temporary. We think that the market will focus again on the credibility of and the strength of the U.S. institutions. And that will lead to a continued erosion of U.S. dollar dominance, not an end to it, but certainly an erosion of it.
Yeah, so it's interesting because on one hand, we talk about the erosion of confidence, perhaps questions around credibility, and that's manifesting or playing out via the USD. But at the same time, U.S. stock markets keep making record high after record high. Can that paradigm persist, i.e., investors have a very positive view of the outlook for U.S. companies, but at the same time, a dismal view of the USD at a macro level?
So we do think that there are still potential gains and that the equity markets could reach new highs in the coming months, so long as investors remain confident that the earnings for 2026 earnings expectations can be achieved, and that seems to be the case. People going to results season being very cautious, expecting some restraints in terms of company comments, but what we are seeing is that, in fact, they are delivering. So long as this confidence remains, we do think that there is possible to have more gains in equity markets. Now, should, of course, yields at the long end start to increase too much, we might have to review this position.
Yeah. Frédérique Carrier, thank you so much. Really good to chat to you the day after such an important meeting as well. Investment strategy head for the UK and Asia at RBC Wealth Management. Now for a look at some of the other stories we're following today. Disney's ABC network is taking Jimmy Kimmel Live off the air immediately after a backlash over the late-night host's comments about the killing of Republican activist Charlie Kirk. On Monday, Kimmel suggested in his monologue that the man charged with Kirk's killing was a Trump supporter. A major owner of ABC TV affiliates, Nexstar Media, had called Kimmel's remarks offensive and insensitive. Tesla says it's working on a redesign of its door handles following a Bloomberg investigation that uncovered incidents of people getting trapped in their vehicles. The firm's design chief told us Tesla is looking to combine the electronic and manual door release mechanisms, which are currently located separately. Earlier this week, the U.S. auto safety regulator opened an investigation into whether some Tesla doors are defective. And Meta has launched the first version of its smart glasses with a built-in screen as it seeks to turn the product into a consumer hit. The $799 Ray-Ban display features a screen in the right lens that can show text messages, video calls, directions in maps, and visual results from web searches. CEO Mark Zuckerberg says the product will be a vehicle for what he calls AI superintelligence. And coming up, China orders firms to stop buying a type of Nvidia chip, tightening its AI clampdown and escalating tech tensions with the U.S. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersechi in Dubai. Huawei has unveiled its SuperPod technology to bundle more AI chips together and boost computing power to challenge Nvidia's technology. For the latest, let's bring in our Bloomberg's tech correspondent, Annabelle Jewelers. Once again, we saw her just a few minutes ago. But first, let's talk about this Huawei news. Essentially, how powerful is this new technology?
Yeah, well, it's powerful enough to be linking thousands of graphic chips together. So I think what's important to acknowledge about Huawei's AI ambitions is that the AI chips it's been able to produce so far, so its Ascend series, are not nearly as competitive as the most advanced that we see from Nvidia. The solution that the company, though, has to this is to create technology to put more semiconductors or bundle more semiconductors into a cluster. So cluster-based computing, I mean, it's common. It's one of the common paths toward creating supercomputers, but this SuperPod technology that the company has just announced can link as many as nearly 15 or 16,000 graphics cards together. So it'll be 16,000 graphics cards, but it's containing, importantly, as I said, that Ascend AI chip. So this is really important as we know that China is really continuing to focus its efforts on really weaning companies off in China off Nvidia technology and really refocusing its efforts to try and build out its self-reliancy essentially in this space. So that plus Huawei also announced a new lineup of AI chips. We're going to be getting a new Ascend product from next year and over the coming years as well, one each year.
Yeah, so you had the Huawei unveiling, and then we've also, as you've been tracking on the shows, the in-house chip, a lot of excitement around Baidu and Alibaba in the last month as well. But all this is coinciding with some new geopolitical developments. China yesterday widening its clampdown on Nvidia chips. What else do we know specifically about what's happening with those chips, specifically the H20, obviously a big focus?
Yeah, it's really fascinating timing, and I think you really can't sort of overstate the significance of it as well, given that Presidents Trump and Xi are supposed to be having a call this Friday. And you've got President Trump right now in the UK, where the Nvidia CEO also is, to announce big investments there. But essentially, what the regulator has told companies in China is that they shouldn't be buying Nvidia's RT6 Pro 6000D. Now, this is a technology that's actually less advanced than the H20, which we know was sort of banned and then not banned, but now China's also trying to encourage companies quite firmly not to use the H20. But the RT6 Pro 6000D is a semiconductor for workstations, essentially, that can be repurposed for AI applications. And so companies are basically being told, stop testing these products, cancel existing orders. This is according to people that are familiar with the matter. The information isn't yet public, but still, as I said, it sort of, again, tracks with the common theme here, which is that China wants to build up its own efforts, focus on its own companies, and you see that, as you said. I mean, we've got Alibaba, we've got Baidu, we've got Huawei today on the upgrade from Goldman Sachs. I mean, it's just been a very, very optimistic sector and space in China just over the past few weeks alone.
Yeah, most definitely. Bloomberg's tech correspondent, Annabelle Jewelers, thank you so much. And coming up, the UN says billions of dollars have been plundered via rampant corruption in South Sudan. We'll bring more details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. The UN says billions of dollars have been plundered via rampant corruption in South Sudan, which has financed conflict and starved the nation of essential services. A report by the Commission on Human Rights in South Sudan says oil wealth has been diverted into the pockets of a narrow elite, pushing the nation to the brink of catastrophe.
One of the reasons we produced this report is South Sudan's not a poor country. It's a plundered nation. And since independence, more than 25 billion in oil revenues have flowed into government coffers.
For more on this, Bloomberg's Nzira Ganga joins us now from Kigali, Rwanda. So pretty damning assessment by the UN there. What are they suggesting of the scope of the plunder of this oil wealth?
Good morning, Jumana. So what they're talking about is how in South Sudan money and politics go hand in hand. And what has happened is public resources have turned into private wealth. And this has locked the country in a vicious cycle of corruption. And what it's in turn causing is humanitarian and human rights crisis. And how we are seeing this manifest is the economy has regressed so far back. You look at GDP per capita. When the country got independence in 2011, it was $1,660, 75% reduction to $421 by 2025. What has also happened is the country now ranks second last in the Human Development Index, and 92% of the population live in poverty. And one might think this is motivation enough for them to be prudent with their resources. It's not. Like the UN was saying, $25 billion in oil receipts, but the accounting is scanty. A lot of money is going into things that are not essential. For example, Presidential Affairs has spent close to $500 million. This is 6 times their allocation. Yet you have critical sectors like like healthcare and agriculture that receive less than 10% of their allocation. And what is now happening is the government is technically abdicating its mandate, and the people are forced to rely on international organizations for healthcare, education, and food. And this is not a sure bet, because we're seeing also funding to these organizations continually reduce. And if you think the pilferage stops there, it doesn't. Oil for Roads was another project that has become a vehicle for corruption and political patronage, where of the $2.2 billion allocated, $1.7 billion cannot be accounted for, and close to 95% of these roads are not completed. But if you ask the government, they attribute this regression to climate change, war, and volatility in the oil market.
Yeah. And let's talk about some of the political developments. The vice president was recently indicted and suspended. How will this play out in terms of the possibility of further civil unrest in the country?
Joanna, the risk is high, because if you look at the statements that are being put out, they're calling on their supporters to report for national duty and defend the nation and the country's sovereignty by all means. Now, this is very dangerous rhetoric, because it leans very ambiguously between political and military statements subject to interpretation. But then again, the UN is not surprised. They say this political unraveling that we're seeing in 2025 is as a result of engineered chaos. This is a country that in 2018, they had an agreement, peace and reconciliation, but what they've done is they have ignored the core and building tenets of this agreement that they had when it comes to fiscal management, when it comes to security reforms. And what happens if they've laid foundation for a perfect cocktail of chaos? And when cracks form at the top, this division will spill at the bottom, risking chaos in an economy that is already very shaky.
Bloomberg's Andira Ganga, thank you so much for bringing us that story. Now for a look at some of the other stories we're following today. Abu Dhabi National Oil Company, ADNOC, has abandoned its planned $19 billion takeover of Australian gas producer Santos. The deal fell through due to disagreements over valuation and tax issues. The decision to walk away is a setback for XRG's strategy to expand globally and diversify away from crude oil. Egyptian authorities are searching for a 3,000-year-old golden bracelet that has gone missing from a museum in central Cairo. The bracelet, linked to an ancient pharaoh, vanished from a restoration lab. A photo has been sent to all border crossings to help prevent it from being smuggled out of the country. Helen, quickly, let me just check my wrist. No, not wearing it. Okay, it's not me. I'm free. Coming up, we're going to be talking about the Fed. Obviously, this is the price action bucking the trend that we had yesterday. A bit of a dip back for Wall Street. Today, S&P futures, NASDAQ leaning towards positive, a lot more than yesterday, I should say. NASDAQ up 0.7%. The S&P up 0.5%. And European markets also up a similar amount as global investors digest yesterday's Fed. They cut 25 basis points, signal 2 more rate cuts for this year, but then perhaps a slower pace going into 26, 27. And one perhaps less hawkish surprise was the fact that there was only one 50 basis point dissenter, and that was Stephen Myron. So we're going to hear more about the impact this is going to have on FX with Ebury's Matthew Ryan. We'll talk about that shortly. This is Bloomberg. Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Risk management. U.S. equity futures gain after the Fed cut rates for the first time this year, with Chair Jerome Powell keeping policymakers largely united despite President Trump's pressure for a bigger cut. Bargaining chip. China bans its tech companies from using the AI chip Nvidia made just for them. The U.S. describing the move as counterproductive. And our big take today: in a broken Palestine, increased Israeli activity undermines the viability of a Palestinian state. We are live from the West Bank. Well, it's just gone 8:30 a.m. across the Emirates. I'm Joanna Bersachi in Dubai, picking up from yesterday's big Fed decision. So they went along with market expectations, cut interest rates by 25 basis points, but did signal, the median dot signal, that we could be in store for another 2 rate cuts by the end of this year. Next year, though, less dovish, so only 1 cut priced in, and 2027 also only 1 cut priced in. So sort of a mixed bag in terms of how the market reacted to this. By the end of the day, we saw a small, moderate pullback pullback for S&P and the Nasdaq, though Nasdaq, of course, being driven by that Nvidia story we've just been covering on the show, and the fact that China have banned some of those Nvidia chips for use in the country. So that's a tech story that we were focused on yesterday. This morning, though, things are flipping up to the green. We've got S&P up 0.5%, Nasdaq up 0.7%, futures looking like they're going to open in buoyant territory later on. And then 10-year yields, we broke through 4% briefly to the downside yesterday, right after the decision. But by the end of the day, we actually ended up 4 basis points higher than where the day started. Tells you a lot about all of the volatility that went on once that decision came out. But 10-year yields now sitting at 4.06, about 2 basis points lower throughout the course of the Asian session. The USD also caught a moderate bid, I would say, up 16 basis points. And so maybe a case of buy the rumor, sell the fact. We'll talk more about that with our FX guest in just a moment. And switching over, our terminal chart for today, also noticeable, the fact that EM currencies, too, have reacted negatively to the reaction to the news that came out of the Fed yesterday, and the fact that obviously you've seen a bid for the USD has not been so supportive for some of those EM currencies, even though into the Fed meeting you saw, as you see from that chart there, the beginning of September, a huge run-up in terms of EM currencies performance, but that dipped a little bit overnight. Now, Arab Gulf nations are also easing borrowing costs after the Fed's first rate cut of the year. The UAE, Saudi Arabia and others trimmed rates by 25 basis points, aiming to support credit demand and housing. The cost of money in Saudi, as measured by the 3-month SIBOR, has seen fluctuations since the start of the year, but is still hovering above 5%. And the gauge of the dollar has risen for a second day, with the Fed Chair Jerome Powell terming the central bank's move as risk management cuts. And now joining us now is Matthew Ryan, market strategy head at Ebury. Matthew, a lot, I guess, of takeaways that we could extract from the Fed meeting yesterday. But essentially, if we could whittle it down into one description, it is a risk management cut. That's exactly what the Fed Chair Jerome Powell painted it as yesterday. So does that take out the possibility of a sequential path of rate cuts in the future?
Well, yes, I think it was a balanced approach from the Fed. They have a lot to balance at the moment. Of course, on the one hand, we have this significant cooling that we're seeing in the US jobs market, which we'd argued before the meeting had left the Fed well behind the curve. But inflation still remains well above target and is likely to trend higher as a result of the tariffs. So the Fed has had a lot to juggle. I think they struck a pretty balanced, appropriate tone, signalling a total of 3 cuts this year, 2 more beyond the September meeting, which was in line with our expectations going into the meeting. But Powell, during his communications, was slightly less dovish. He continued to stress that the focus is on controlling inflation, and that's still an important part of the mandate. And interestingly, I think probably the biggest takeaway for us from the meeting was that not only did we only see one dissenter in favour of a 50 basis point cut, but we only saw 1 cut priced in for 2026, when nowhere near fully endorses market pricing. I think that's an acknowledgement that the Fed is not only worried about inflation, but also worried about spooking the Treasury market, particularly given the inflation risks posed by the tariffs.
Yeah, and we were saying, bringing it back to FX, that it was going to be difficult for the Fed to validate some of the rate cuts that were priced in by end of 2026. There were 6 cumulative rate cuts priced in before the event. And that certainly does appear to be the case. Does that explain some of the price action we had in the greenback yesterday?
Yes, I think so. I mean, the dollar was initially lower in the knee-jerk reaction and following the release of the dot plot. I think as markets realised that the Fed was effectively confirming 3 cuts this year. But then if we look into 2026, as I said, still only 1 cut priced in or expected for next year. That's much less aggressive than priced in by markets. We'd expected a slightly more narrower gap between the two. We thought that the Fed would more closely endorse the market than it did last night. Actually, it only suggested that 1 more cut between now and the end of next year relative to its June forecast, which isn't too much of a revision. So initial dollar sell-off, but actually it recovered a little bit of ground following Powell's slightly more hawkish communications and off the back of that 2026 dot, which wasn't quite as dovish as I think markets had anticipated.
Yeah, you're also seeing a pullback in the euro, which is, I guess, part and parcel of the strength in the USD. We're getting close to 118 again. Do you think that euro can continue its march higher? Do you have 120 as a target, like some of the other analysts that we speak to have?
Yes, long term, we still think that euro dollar will grind a little bit higher from current levels. We're actually looking at around about the 120 level heading into the new year. I think that's a reasonable assumption. On the one hand, we think that we will see a convergence in economic performance across the Atlantic. The US, we think, will continue to slow, partly as a result of the tariffs. And of course, this slowdown we are witnessing in the jobs market. The Fed also has much more room to cut than its peers. We are yet to see the full impact of Fed cuts on the dollar. We think that means that risks to the greenback are skewed to the downside. And actually in Europe, the outlook is becoming increasingly rosy, particularly given Germany's stimulus program. And we do think a grind higher in euro dollar is on the way.
Yeah. Let's talk about the Bank of England. We also have a central bank decision coming up today. Poor Bank of England, no one's been giving it a lot of attention, but of course there is a meeting coming up. No one's expecting a rate cut. Yesterday we had inflation data still quite elevated, highest level since 2024. There could be a tapering announcement. What does all that do to the pound, or is that to a certain degree all priced in at this point?
Yes, I think so. I think that today's meeting from the Bank of England will be slightly more of a non-event than we saw yesterday from the Fed. There's practically no chance of any change in rates, nor do we actually expect there to be any more cuts between now and the end of the year. Granted, we could see a couple of dissenters in favour of a cut today, and the does will no doubt cite the concerns over the state of Britain's jobs market, which I think are warranted. But, as you said, inflation is still running very high, almost double the 2% target. And I think the officials, are similar to the Fed, are wary about triggering another jump in long-dated gilt yields. All that means we think the prolonged pause is probably on the way. And actually, I think there's a decent chance that we do see the MPC hinting at that today, either by ditching or tweaking its gradual and careful guidance, which I think probably would rule out another cut at least until February next year.
Okay, Matthew Ryan, Market Strategy Head at Ebury, thank you so much for joining us nice and early in London. Thank you so much. Well, we just had some breaking news come through. This is per FT reporting, saying that China has dropped the Google antitrust probe during U.S. trade talks. So remember, these were trade talks that were taking place at the beginning of the week in Madrid. We'd spent a lot of time talking about that TikTok framework deal, but FT are now reporting that China have now also dropped the probe into Google. So that could be a very positive signal for Alphabet. Remember, earlier on this week, Alphabet did actually break through $3 trillion market cap on a positive momentum out of the U.S. antitrust probe. So this is coming through from the FT now, suggesting that China may also be looking to drop their own antitrust probe. So that's some breaking news. All right, Britain's King Charles has urged the defense of Ukraine and the environment at a lavish state dinner at Windsor Castle. The king spoke up while offering a toast, welcoming President Trump and top tech and finance executives. U.S. and UK officials expect to roll out economic deals worth billions of dollars to coincide with the visit. For more, let's bring in Bloomberg's Lizzie Burden, who is still in Windsor. You've been there the last couple of days. Lizzie, what do we know about last night's state banquet, the king's speech? Anything new come out of it?
Well, they dined, Joanna, on organic Norfolk chicken. They washed it down with a transatlantic whiskey sour, this new cocktail designed specifically for the event. And round the table, as you say, you had the biggest names of Wall Street and Silicon Valley as well, the likes of Jane Fraser, who you just had on the programme recently, of Citigroup, Nvidia's Jensen Huang, Steve Schwarzman of Blackstone. And in terms of that speech, from what we know from the readout of it, the King said that we are kin to the president. He noted the president's fondness for British soil when it comes to making golf courses. But the serious point he made was that they need to share an urge to defend Ukraine and defend the environment. So notably, hitting on two of the fault lines between the UK and the US at the moment. A dinner that really was designed to curry favour with the president, but notable as well because usually the monarch traditionally would have restraint in delving into these controversial issues. But as we know, the king is not the Queen Elizabeth II, and here he was making a real statement to the president on his visit.
Yeah, most definitely. What about today, and what exactly should we be watching out for in terms of potential announcements and also a meeting between President Trump and the Prime Minister?
Exactly. Well, if yesterday was all about pageantry, today is all about getting down to business. And the president is going to head from Windsor Castle to the Prime Minister's country estate at Chequers. The tech bosses will be there as well. We're expecting tens of billions of dollars of investment in tech to be announced for Britain. £150 billion of spending on infrastructure, or total investment, I should say, in the UK. Starmer's team saying will be unveiled. Starmer hoping to press Trump on trade terms, on Ukraine as well, though we're not expecting any major breakthroughs, and we're not expecting him to try to raise the Middle East. The Times of London reporting late last night that, in fact, Starmer is going to wait until the weekend to recognise Palestine as a state. So avoiding, hopefully, a diplomatic incident by waiting until after Trump's departure, after the state visit, but doing it before that UN General Assembly meeting in New York next week. Now, the president has previously said that doing so would reward Hamas, but the previously outlined plan from Keir Starmer would be to say that this will happen if Israel does not agree to a ceasefire, does not commit to a two-state solution, and does not make plans, make clear that it would not annex the occupied West Bank. So it looks like this is going to happen at the weekend, but it really could dominate the press conference.
Well, teeing up our next segment, well, Lizzie, thank you so much, Lizzie Burden. Because also coming up on the show, we are going to be talking about France saying it will recognize a Palestinian state at the annual United Nations General Assembly, the UNGA, in New York next week. But how viable is the two-state solution? Our big take next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Israeli troops have been pushing deeper into Gaza City as more people flee the devastated area. Palestinians say the strikes have cut off phone and internet services, making it harder for people to call ambulances during the new Israeli offensive. Local health officials say the Palestinian death toll has now surpassed 65,000 people, and Israel says it's launched what it calls an intensive military operation towards the heart of Gaza City to confront Hamas. The European Union has proposed suspending Israel's preferential trade benefits as part of a new package of sanctions in response to the humanitarian crisis in Gaza. The move means Israel will be charged the same tariff rate as other nations that don't have a trade accord with the bloc. The move would require a qualified majority amongst the 27 member states, and countries, including Germany, have opposed punishing Israel.
The aim is not to punish Israel. The aim is to improve the humanitarian situation in Gaza. All member states agree that the situation in Gaza is untenable. The war needs to end. The suffering must stop, and all hostages must be released.
And France says it will use the annual United Nations General Assembly in New York on Monday as a platform to become the first member of an advanced economy to recognize an independent Palestine alongside Israel. Several Asian countries, as well as the UK and Canada, may also do the same. But the reality on the ground in Palestinian territories is different, and for many, the flurry of diplomacy probably comes too late. Let's go to Bethlehem now and speak to Bloomberg's Fadwa Hodali. This is the subject of today's big take up on the terminal. Essentially, you've had a big move out of countries, advanced economies, including the likes of France, towards recognizing a Palestinian state. But the question is, what would a Palestinian state actually look like today?
Well, actually, good morning. The Palestinian state will these days look fragmented. West Bank under Palestinian control, Gaza devastated and destruction of the ongoing war, and the East Jerusalem that Palestinians hope as a capital is annexed by Israel. So the reality on the ground is completely what would Palestinians hope for? Meaning by fragmented, the settlement expansion, the roadblocks, the settler attacks, the daily life, the restriction of movement. This is all affecting any future state that the Palestinians will hope for.
The Israeli government has categorically rejected the prospect of a two-state solution. Is a two-state solution, therefore, still viable?
Well, it depends of how you look at it, actually. If you look at it from a diplomatic way, it's an intent by the international community to revive the two-state solution after what took place in Gaza. But if you look at it on the ground, the reality on the ground is completely different. After October 7th, the international community has realized that ending the conflict is a must for Palestine and Israel, and they need to take tangible steps. Now, is recognizing the state of Palestine is a step. It's a pressure by the international community on Israel, but you need the political will in order to achieve that. And if there is no political will, then you won't be able to achieve anything on the ground, actually, because the facts on the ground is completely what the international community hopes for. You know, the West Bank has witnessed a silent expansion of settlement, a silent expansion of attacks on settlers, by settlers on Palestinians, roadblocks, restriction of movement. This is all are creating huge obstacles to create a Palestinian state. The international community for years have kept silent and have not recognized the state of Palestine. And now they're trying to raise the time in order to achieve that. But without a political will, again, this is going to be very, very, very difficult to achieve.
Bloomberg's Fadwa Khadali joining us from Bethlehem. Thank you so much for your time today. And a reminder that the Big Take alongside graphics is on the Bloomberg terminal this morning, NI Big Take Go. Now, Saudi Arabia and Pakistan have elevated their long-standing security partnership by signing a mutual defense pact. The two countries stated any aggression against either one shall be considered an aggression against both. The pact comes after an Israeli strike targeting Hamas leaders in Doha strained relations between the U.S. and key Middle East allies. And coming up, we speak to Alex Okosi, Managing Director for Africa at Google, about the company's new subsea connectivity hubs connecting the continent to the world. That's next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Now, Google is investing billions of dollars to improve digital connectivity across Africa, including subsea cable hubs as part of its Africa Connect program. The investment aims to provide broader access to the internet and emerging technologies like AI, helping to accelerate the continent's economic growth. Bloomberg TV's Jennifer Zabazaja spoke to Google's Managing Director for Africa, Alex Okosi, about the plans.
How they're different is that they really do now enable us to actually land the cables within the continent in a much more effective way. As you know, being able to build a subsea cable still requires that you land them in different markets. And that's what we've been working hard to do. When you have these connectivity hubs, they then really maximize your opportunity to be able to partner with the telecommunication companies on the ground to again, reduce the cost for the average user in terms of being able to access the internet. For us, it's foundational to be able to create more connectivity, being able to kind of have that foundation for us to really leverage this new AI opportunity that we have for Africa is really critical. So the connectivity hubs are quite quite a significant investment, but it's important for us as we see it to be able to really maximize the opportunity to ensure that the bandwidth that we are creating with the subsea cables are effectively utilized by our partners on the ground.
What went into actually landing the cables? I know you can't tell us specifically where the connectivity hubs are, but maybe you can talk about regionally what they're going to do and how you're able to get this over the line.
Look, I think regionally what they're going to do, we're going to land 4 of them, right? So North, East, West, and Southern Africa. And the idea is going to be really how do we then enable, telco players, last mile players on the ground to be able to again leverage it, to again start reducing the cost for our consumers and our communities to get online. To be able to sort of get it over the line is really being able to, again, continue what we have been doing as Google, which is investing in making sure that we are part of Africa's digital transformation. So for us, it's a clear focus. The foundation for our strategy is about connectivity, and we continue to invest in that.
That was Google's Managing Director for Africa, Alex Okosi, speaking to Jennifer Zabazaja. Well, this is how equity futures are reacting to that Fed interest rate cut yesterday. Quite buoyant this morning. S&P futures up 0.5%, NASDAQ up 0.75%. But I will say, keep an eye out on some of the tech stories, especially the latest story that this dropped throughout the course of our show. FT saying that China have now dropped the Google antitrust probe. So Alphabet, one of the stocks to watch later on in the U.S. session today. European markets also seen opening up in the green. We will continue to bring you analysis of the Fed in the later shows. That's it for Horizons Middle East and Africa. I'm Joanna Bersachi in Dubai. Stay with us for Daybreak Europe.